You've done the LLCs, the umbrella policy, the whole asset protection checklist, and you feel pretty covered. Then you find out the biggest threat to what you have built isn't a lawsuit, it's a tax bill your family gets when assets change hands, and it can be hundreds of thousands you never saw coming. I'm Ali Talai, a California asset protection and trust planning attorney and also founder of Talai Law Offices. Today, I will show you why asset protection isn't just about lawsuits anymore and why many California families quietly lose more wealth to taxes than they ever would in court. And if you want to see how I structured these plans for California real estate investors, LLCs and holding LLC strategies, trust, including irrevocable trust, and layered asset protection, I cover it in my free asset protection webinar. The link is in the description or it will be on the screen. You can also go to my Instagram, Talai Law Offices, and DM me the word webinar and I will send you the registration directly. All right, so here's the mindset shift I want you to make today. Asset protection is really about controlling exposure. That is the key here. Sometimes that exposure comes from a plaintiff's attorney. Somebody slips and falls on your rental property. Somebody files a frivolous lawsuit. Those are all real threats, and you need a plan for them. But sometimes that exposure comes from the tax system itself. And either way, the result is exactly the same. Your family keeps less of what you have built. Now, most people think estate planning is about avoiding estate taxes, and I understand. I understand why you may feel that way. You hear a bunch of stuff on the news talking about estate taxes, and it sounds pretty scary, but here's the reality. The federal estate tax exemption is now $15 million per person. So if you're married, that's a $30 million exemption. And for most California families, estate taxes is not the danger. The real danger is capital gains tax and how it shows up at exactly the wrong time. Let me explain that in plain English because this is where it really matters. Let's say you bought a property here in California for $1 million. Over the years, the property appreciated and now is worth $3 million. That is a $2 million increase in the value just sitting there quietly. No tax on it yet. It feels completely harmless. It's great. We actually feel pretty good if we bought a property for $1 million and now it's worth $3 million. But here's the thing. If the asset gets sold or transferred the wrong way at the wrong time, a large portion of that gain disappears to taxes. We're talking about federal capital gains, the net investment income tax, and California state tax on top of that. In California, you could be looking at a combined rate approaching 37.1% on that gain. On $2 million of appreciation, that could mean about $742,000 going to taxes. The IRS, the real creditor in some cases, or the hidden beneficiary in your trust. And here's what surprises a lot of people. The tax system treats assets very differently depending on how and when they move from one person to another. Handled one way, decades of built-in gain can be dramatically reduced or even eliminated through what we call the step-up in basis. Your kids will inherit the property with the tax basis being reassessed to the current market value. I'm not talking about property taxes. I'm talking about your income tax basis of the property. Well, unfortunately, property taxes will get reassessed in most cases thanks to Prop 19. But let's talk about if it's handled another way. That same gain turns into a massive tax bill for the next generation. And once that happens, you cannot undo it, unfortunately. That is not accidental. That is how the system is designed. And this is where asset protection thinking really matters. Just like how lawsuits are about leverage and, who can reach what sort of assets, tax outcomes are also about leverage. timing, control, structure, those sorts of things. I see this in my practice all the time. Some plans do a great job protecting assets from creditors, but they accidentally expose families to unnecessary taxes. A client will set up an irrevocable trust to get assets out of their name, and that is fine for lawsuit protection, but if the trust is structured as a completed gift, those assets may not receive a step up in basis when the client unfortunately passes away. So the kids inherit the property with the original low basis. And again, I'm talking about tax bases, not property taxes. As I mentioned earlier, they get reassessed in most cases here in California thanks to new Prop 19 rules and regulations that passed in 2021. And when the kids go to sell the properties, they get hit with a capital gains tax bill that could have been completely avoided. So some plans are designed with flexibility so families can adapt as the rules change and circumstances evolve. And that flexibility is what separates good planning from planning that creates new problems down the road. The difference isn't that they're lucky, it's that they just had a plan that was designed much better. One of the most common mistakes I see in my office is one-dimensional planning. People come in and they say things like, I just want it out of my name, or I just want to avoid probate, or I just want liability protection. And those goals aren't wrong. I understand why people want those things, but they're incomplete. Because asset protection isn't just about today. It's about the entire life cycle of the asset. While you're alive, while you own it, while you control it, and when eventually changes hands to the next generation. If you only solve for one stage, you often create risks somewhere else. Let me give you an example. I had a client who owned a rental property in Orange County. Beautiful building worth about $6 million. They transferred it into an LLC for asset protection purposes, good move for liability purposes, but then they gifted the LLC's membership interest to their children while the parents were still alive, thinking they were simplifying things and avoiding probate. All right, so then you might be asking, what's the problem? The gift carried the parents' original low tax basis to the children. They refer to it as a carryover basis. When the parents eventually passed away, there was no step up in basis because the parents no longer owned the building, owned the LLC membership interest. It was already gifted. The children later sold the property and got hit with a capital gains tax bill of over $1.6 million. $1.6 million that proper planning would have completely eliminated. And here's the hard truth that I want everyone watching this video to understand. Losing 30 or 40% of an asset to an unnecessary tax is no different than losing in a lawsuit. The damage to your family is exactly the same. The only difference is that tax losses are quieter. Nobody serves you papers. There's no courtroom drama, and people tend to blame themselves instead of recognizing that a better plan would have prevented it entirely. Sophisticated asset protection looks at all predictable threats, not just lawsuits, not just creditors, but tax exposure that shows up when families are least prepared to deal with it, which is usually right after they have lost a loved one. This is why you hear me talk more about control than ownership, more about flexibility than performance, more about structure than a specific tools. Because tools change. Tax law changes. The estate tax exemption will definitely change again, even though they're calling it permanent. It's just permanent until it gets changed again. California tax rates could change, but leverage always matters. When I design an asset protection plan for a client, I am not just thinking about what happens if they get sued tomorrow. I think about what happens in 5 years from now, in 10 years from now, when they pass away, and when their children eventually sell or transfer those assets. Every stage matters. and the best plan account for all of them. In my practice, I often use what I call an incomplete irrevocable asset protection trust. Incomplete irrevocable asset protection trust. And what that really means is that we can structure the trust in such a way that it provides strong asset protection from creditors, but it still includes the assets in the grantor's taxable estate. And that is the key, because when those assets are included in the estate, at the time you pass away, your children can receive that full step up in basis. So they get the protection while you're alive and the tax benefits when the asset transfers. That is the kind of planning that saves family real money, not theoretical money, real money we're talking about. So if you take one thing away from this video, let it be this. Asset protection is not about stopping people from taking your assets. It's about preventing predictable losses, no matter where they come from, whether it's a plaintiff's attorney, a creditor, or the tax system itself. The goal is the same. You want to make sure your family keeps as much of what you have built as possible. And here in California, where property values are high, where appreciation happens fast, and where we have some of the highest state income tax rates in the country, this kind of planning isn't optional. It is essential. Now, I know a lot of people have heard different things about asset protection, and not all of it is accurate. Believe it or not, they're not all accurate. There are some very common myths out there that lead families to make mistakes they cannot easily undo. In my next video, California Asset Protection Myths Debunked, I'm going to break down the biggest misconceptions I hear in my practice every single week and show you what the law actually says. If you're serious about protecting your wealth and your family's future, you do not want to miss this next video. I look forward to seeing you over there.